Hello everyone, welcome back to One Finance, and in this video we're going to cover bond investment strategies. Now, same with stocks, if you are investing or trading bonds, you need to have strategies. And you can start by plotting the yield curve and the risk-reward trade-off. Now, if you can recall, the yield curve would give us the idea that shorter tenor bonds offer lower yields compared to longer tenor bonds. Okay, and then relative to the risk reward trade off, we can conclude that shorter tenor bonds have lower risks, therefore lower returns or yields compared to longer tenor bonds. Okay, so we have to understand three concepts here. Number one is yield. So yield is the profit from bond investing. So this is the same as interest or return on investment. Now, for example, here you're looking at a 5-year tenor bond. Let's say the yield 6 months ago is around 4.4%. And a month ago, that's around 2.7%. And the latest figure we have as of July 14, we have around 2.3% gross per annum. Now, the second concept here is the tenor, which is the length of time before a bond matures. Now, unlike stocks, which are perpetual, meaning they don't have maturities and you can easily sell them or buy them from the secondary market. Now, bonds, they have a certain requirement or time frame requirement. For example, if you want to have this yield per annum around 2.3%, then you have to stay invested in this bond for 5 years. So, in short, bonds are debt instruments. So they have specific um, time requirement for you to stay invested. Otherwise, if you sell them prior to maturity, you may experience interest rate risks, which may affect your capital. It could be, at a premium, and it could be at a discount. So depending on the interest rate environment, when the time you wanted to sell or unload your bonds, your capital or the bond price will be reassessed using the prevailing interest rate. So meron tayong video nen sa introduction to bonds or fixed income. So kung hindi nyo pa napanood, kindly watch that and you will have, ideas about how to trade. Okay, the concept is trading, how to trade um, fixed income or bonds in the secondary market. So going back here, we have the third concept. Duration is the sensitivity of a bond to changes in interest rates. Now, yung bonds natin, okay, they are allergic to interest rates, and their relationship is known to be as inverse. So, for example, if we have higher interest rates, then that would push the bond prices to go down. And therefore, if we have lower interest rates, then that would push the prices to go in an upward direction. So, merong inverse relationship. Now, going back to that sensitivity, okay, that would also relate to tenor. So in short, shorter tenor bonds, they have low duration or low sensitivity to interest rates. While here we have longer tenor bonds, that would mean that they have longer or higher duration and higher sensitivity to interest rates. So the rule of thumb in bond investing and trading is that longer tenor equals high yield equals high duration equals high risks, and high risk equals high return. So the concept here would, draw us back to the general rule of thumb in investing, which is, low risk, low return, and then high risk, high return. So in that's the same concept in bond investing or bond trading. So here we have the first strategy in bond investing. The first one is what we call the ladder strategy. So here, the portfolio is consist of bond investments with different maturities. So we have intermediate bond funds maturing less than 3 years. We have medium bond funds or medium term bond funds maturing in, let's say, 3 to 5 years, and long term bond funds maturing in more than 5 years. So the combination of those types of bonds would give you the benefit of, liquidity and optimized return. Now, for example, here, meron kang 2-year na retail treasury bond, and you also have dollar currency, government security, or the ROP, and then you have the treasury bond and corporate bond. Now here, if you can see, meron siyang different tenor. So again, different tenors would give you different combination of yields. So yung 2-year mo, medyo mababa yung yield niya compared sa 10-year tenor na bond. But the thing is, every, every 2 or 3 years, you would have the liquidity. Kasi eto, magmamature na siya after 2 years. So meron ka ng, um, let's say, fund. And then after 5 years naman here, meron ka na ring maturing ROP. So meron kang liquidity. So almost every 2 or 3 years. And aside from, of course, yung coupon or the interest that you would get from these bonds, let's say in a quarterly or semi-annual basis. Now, yung second requirement natin, or second strategy rather, sa bonds is what we call the bullet strategy. Now here, the portfolios consist of bond investments with the same target maturity date. Now, let's say yung 2025 is a very significant year for you. Let's say you would want to have your grand wedding or buy your first car, or let's say your first house. So yung composition mo, for example, ng fixed income or bond portfolio would be for, let's say, 2020, kumuha ka ng 5-year na retail treasury bond, and then 2021, 4-year ROP, and so on and so forth. So in short, in a span of, let's say, 5 years, yung investments mo are actually geared towards, having the same target date of 2025. So, yung 5-year mo, again, mas mataas yung yield niya compared sa, let's say, sa 3-year treasury bond mo and sa 2-year corporate bond. But the most important thing is that yung liquidity mo dito sa 2025 is very high because lahat ng bonds na ito magmamature on the same year. Okay, so that's the bullet strategy. And the last strategy, we have the barbell strategy. So here, the portfolio is consists of bond investments with both short-term and long-term maturity dates. So, alam na natin yung short-term, no, or intermediate bond funds. Ito yung mga bond funds na or bonds na merong less than 3 years na maturity. Yung long-term naman, ito yung mga bonds natin na with, let's say, um, more than 5 years. Let's say 5 to 25, 30 years in maturity. So, yung concept is that yung, let's say, itong left side ng barbell mo would be focused on intermediate bond funds, okay, multi-currency peso and dollar, and then yung sa other end naman ng dumbbell mo is focused on long term. So different tenors would have different duration, therefore you would have different combinations of, let's say, yield, short-term or intermediate bond funds, and ng long-term bond funds. So at the same time, na-address din yung short-term liquidity needs mo, let's say after 2 years, and then after 5 years, yung long-term liquidity needs or your financial objective after 5 years. So those are the three strategies in bond investing or bond trading. So I hope that you learned new things in this video. And as always, thank you very much for watching, and see you again in my next video.